Hey, what is up guys, and welcome to Paul Mark's Finance YouTube channel. I'm your co-host Vash, and today we're going to talk about dividends, as you've probably seen in the video title already. So let's get on to the video. So before we get into the dividends, we should first focus on the free cash flow of a business. The free cash flow of a business tells us the amount of money that the company has in a certain period of time. With this money that is left over, the company can use it in three main ways. One of the main ways is basically retaining the money, which means that the company doesn't use the money for anything, it just saves the money for a later occasion. Another way of using the free cash flow is basically reinvesting the money back into the business. By reinvesting the money back into the business, the company will be able to purchase new assets, new equipment, and even purchase new subsidiaries, which will make the equity grow. Third but not least are the dividends. The dividends are basically a way of the company to give value directly to their shareholders, which means that they'll pay an X amount of money to you for owning their shares. This money that is given to investors in the form of dividends is basically taken from the free cash flow. This means that for each dollar or each penny that you take from the free cash flow, you're taking $1 or one penny that could be reinvested into the business, which will grow the equity in the long term. Another two ways of using the free cash flow of a business is one, paying off the debt that the business already has, and two, using it to buy shares back into the business. This will make the shares already existing more valuable. Before we go more in depth about the bad parts of owning a dividend stock, I want to first talk about the good parts of owning one. So the best part of owning a dividend stock is that it will give you value directly, which means that to receive money you do not have to liquidate your position, and in this way it will be easier for you to actually recover your money invested without having to actually sell the stock you bought. Another good thing about dividend stocks is that if the company is sitting on way too much cash, the company can use the dividends to actually get rid of that cash. It's a bit risky to stay on way too much cash, and sometimes the cash won't be well invested. Sometimes the cash is actually given to the CEO and the other senior management because the company just doesn't know how to actually use it and decides to give more incentives so they can reach better goals. It can be good, but it won't help us as investors to actually receive more value directly. The dividends will also help you with the snowball effect, which is mainly known as compound. Basically, you will get the value directly, and with that cash flow that you receive from the dividends, you can reinvest them in the company. And the more you invest in the company, the more you will gain, the bigger the ball will become, and that's basically the snowball effect. So now let's get on into the bad side of owning a dividend stock. So the first bad thing about owning a dividend stock is that you have this thing called dividend traps. So what are dividend traps? Dividend traps are basically when a stock has a payout ratio or a dividend yield that is too big or too good to be truth. This mainly occurs because the company wants to attract new investors or even bigger investors to the company, even though they might be a troublesome company, which means that they can have a lot of debt or they cannot be on a good financial situation right now. Thus, you should always ask yourself if the dividend yield that the company is giving is way over the board, because it can be unsustainable for the company to have that big of a dividend yield. Not only they won't be able to continually grow the dividends, but they won't be able to invest in the equity of the business. So here we have a great example of a dividend trap. You can see the company is Suburban Propane Partners LP, or SPH as a ticker. So we'll start out with the payout ratio, which means the total amount of dividends divided by the net income of a company, and this will give you the amount of net income given to the investors through dividends. You can see that the payout ratio is always above 100, which basically means that the company is giving out more money that they actually get from the net income to their investors through dividends. So you might ask, like, where does this extra money come from? You can see here in the free cash flow per share that the free cash flow per share is actually below the dividends, which is kind of worrying. Like, where does this extra money come from? Now you may be really worried about this, because the answer is that this cash flow will most probably come from debt, which means that the company is taking on debt just to give out money to their investors. And this doesn't make sense at all, because when you take debt, you want to improve the equity of your business, not just take debt, which means that you pay a lot of interest, just to give out that money to the owners. You're not taking money, you're basically giving out debt to the owners because they'll have to repay it later. So we'll also see the debt to equity here. The debt to equity from 2010 to 2017 has always been rising. And this is kind of worry because you can see that the debt is already at 2.3 at 2017, and this is a big debt to equity, and they were also rising dividends from 2010 to 2017, which kind of worries, like,
if you invested the company in 2016 or 2017, you'll get a huge cut on 2018, and if you invested it for the dividends, you'll be kind of losing the purpose of owning that company. This is mainly highlight points that you should check before buying a company for its dividend yield or a good payout ratio. As you see, 700 payout ratio is a dream, but you can see that the company is not doing well at all. So please just be careful with that.
So the second bad thing about owning a dividend stock is that you can be missing out on better returns. So what I'm trying to say is when you own a dividend stock, it's a good and a stable way of getting the value directly to the investor, although the equity of that business won't grow as good as a growth company will grow their equity. Which means that the growth company will basically stay with more of their free cash flow and rather invest it on the equity of the business than giving it out to the investors through dividends. You should always remember that if you live in a country where you pay way too much taxes on capital gains and dividends, you will prefer to go for the capital gains instead of going for the dividends, and we'll explain why on this next example.
So here we have the 2019 short-term capital gains tax. This applies to those who actually sell their shares before it passes 1 year of owning them. It also applies to the dividends that the company gives to their shareholders. So if you actually receive like a 50-cent dividend, you'll have to pay 5 cents in dividend, which is 10% of what you got from your dividend to the government. On the other hand, we have the long-term capital gains tax bracket. To apply to this tax bracket, you'll have to own your shares for more than 1 year, which basically means that you can own them for 2, 5, 10 years, whatever. As long as you own them for more than 1 year, you'll be applying to this tax bracket. And you can already see there's a big difference between the short-term tax bracket and the long-term tax bracket, where in the short-term tax bracket, you'll have to pay a tax that is between 10% to 37%, whereas the long-term capital gains tax bracket, you'll only have to pay from 0% to 20%. Now we're going to look at two companies that are being traded at $10 a share each. These companies are both fictional, and I'll call them Josh Equipment and Overseas Candy, and they'll both offer 10% return, where one will offer 7% return through equity and 3% return to dividends, while the other company will give you 10% return through equity and 0% return through dividends. In this example, we'll be more focused on the dividend yield tax rather than the capital gains one. So basically we'll go through the first scenario where Josh Equipment will give you a 7% return through equity and a 3% return through dividend yield. This means that they'll give you 70 cents through equity and 30 cents through dividends. And you'll get a 10% tax on the 30 cents, so basically you will lose 3 cents, and this will give you a total gain of 97 cents. So comparing now to the second scenario of the Overseas Candy, you'll have a 10% return through the equity and a 0% dividend yield. This means that you'll get $1 through equity and $0 through dividend yields, because the company does not offer any dividend yield, and for that reason you won't pay any taxes because you will not liquidate your position. This will give you a total gain of $1. Comparing both total gains of the companies, we can see that there's a difference of 3 cents. So imagine we actually have 10,000 shares of each company. This will give us a total gain from Josh Equipment of $9,700, while Overseas Candy will actually give us $10,000. So we can conclude that Overseas Candy outperformed Josh Equipment without giving any dividends to their shareholders. So this shows us that dividends are not as good and not as efficient as we thought they were.
So another bad thing about dividends is that they can be cutted or they can be halted. This means that the company can stop giving out dividends for a certain period of time, or they can actually just decrease the amount of dividends given out to the investors. This happens because the company will most probably be struggling financially, or they just want to hold more cash. So why is this actually a bad thing? Usually most investors see this as a bad thing because it shows the company does not have the same capability to actually repay their investors as they used to. This usually is offset by lower earnings than expected, which means that the company is not making as much money as they were doing. Sometimes it's not the case because companies can just halt or cut their dividends because they are planning to buy a new company which will become their subsidiary, or they just want to hold more cash in the company in case of something bad happens like a recession or a pandemic. And yes, I did mention the pandemic because of COVID-19 if that's what you're asking.
Be how the you know this? How? Hold on, bro. How?
Basically, the COVID-19 is a great example of dividend halts and cuts that are actually happening right now on the airline stocks and cruise ship stocks. This happens because the companies are actually mostly prohibited of doing their operations, which basically decreases drastically their revenue, which won't let them pay the dividends to their investors. And that's about it for this video, guys, and before you go, let me just say that I really hope you enjoyed the content, and if you did and if you found anything valuable from this content, please smash that like button and subscribe, because we'll be uploading videos soon and you do not want to be missing out on them. We would really like to know your opinion on dividend stocks. Do you think they're good? Do you think they're bad? Do you own any dividend stocks? And if you do, which dividend stocks do you actually hold? We would like to know that in the comment section below, so we can talk with each other and get new ideas for investments or actually share our insights about dividends. So without further ado, see you in the next video.